Ira Epstein, and here we are with your morning flash update for this Wednesday, the 13th of September, CPI day. It's 8:15 a.m. Central Time. The report has come out. The market reaction so far, we are looking at stock indices basically lower with the exception of the Russell. The gold market is lower, in fact, made a new break low down to 1927. The dollar is every side of unchanged. It's only up 7 ticks. It did get as high as 105 on the number when it came out. You're a little bit of everywhere right now. There's been a big flip-flop today. The bets were that the European Central Bank was not going to raise rates. In fact, the probabilities went under 50% as of yesterday. Today, the market flipped that and went to 68% probability. Very strange that they would raise rates. Now we're looking at energy prices pretty much unchanged here. The reaction to the bonds and notes, well, you've rallied 18 points off the low. So the market immediately added yield, but it is moderated as traders are starting to think about what these numbers meant and what they did. And we'll get to them in a minute. I'm not going to abandon you on that. Grain market still trying to go like this to yesterday's crop report. The corn market up a little bit, but I wouldn't be surprised if we end up at 460 somewhere along the line here, about 20 cents lower from where we're at overall. So let's talk a little bit about the numbers. So here we go. First, the mortgage market numbers. As you can see, we've got a mixed bag. You were down 0.8% on the index, but you went up a little bit on the purchase and down on the refi. Applications keep falling as a whole. They're back to 1996 levels, according to the MBA. Now, consumer price. The index itself, right at the expectation on the headline number, up 0.6. Core, which is ex-food and CPI, up 0.3, hotter than the expected up 0.2. Energy prices explode. Last month, that's July, they had been up 0.1. Now they're up 5.6%, and we do import oil, remember that. CPI food prices, well, they were right with what's thought, up 0.2. So that gives you the CPI price index year over year at 3.7%. They expected at 3.6. And the core, ex-food and energy, was up 4.3. That's right where they expected, and that's down from the 4.7. So what is this going to do with the Fed? How are they going to look at this? Let's take a look at one more chart that I've got for you. This is the CME Fed Watch page. It is live, so I have this right on the internet, and this is where they're at. There is a 97% probability the Fed, this is what the traders are betting, for September are not going to move at all. They're going to sit tight. So this report went from 93 yesterday. If you go to this, you'll see what the prior numbers were and all. So the traders are saying this isn't enough to move the Fed one way or the other for this, and that means that they have to go like this. All right. Real estate numbers, I said that wrong. Retail sales numbers will be the next thing that the Fed looks at, and that's going to come out on Friday. So it's going to take a huge number to take you off 97%. So if you're a betting person, the market is saying, hey, Fed is going to sit tight. Okay. Would I? Well, that becomes the interesting question. I'll share this with you. No, I would vote for the quarter-point hike. I'm one that the economy is still so strong, it can afford another quarter-pointer here to make sure you fall. Let me give you that argument. You're going, and let's assume you fall 0.3% a month. How do you get to 2% when you're at 4.3? Do you realize how long that is going to take? And that's without bumps in the road and the economy maybe getting better over time. How do you get to that 2%? So I am the opposite. I am the person that says, number one, the economy is strong enough, and that's the important thing, and labor is strong enough to afford another quarter-point hike now, and then we sit back and we see, is that going to get things going into the end of the year? Versus, let's hold off, we'll see if we do anything in November. Well, how this is all going to work is you rarely get the Fed giving you a Christmas gift of a rate hike at December. You know, they don't want to be the Scrooge in the room. It's very difficult. That's my point on that. All right. I want to remind you, we're going to be having a live webinar to discuss all of this. And that webinar, that is going to be tomorrow. That is Thursday. At 12:15 p.m. I open it. At 12:30 I begin it. If you didn't get an invite already, it means you're not getting one. We still have some seats available. They will fill. How do you get to your seat? See up here, move your cursor. You will see an icon. Give it a click, fill out the form. You will get your link that you click to get into the room, your passcode that you will need. If you have questions on stocks, ETFs, please write them to me ahead of time. Don't expect me to create the charts on the fly for them. I can do it, but I won't be able to put the window envelope studies on them. So just understand that there's a limitation as to what I can do given the time I have. And then some of the averages will be wrong, whether it's 3-day average highs or lows and how I teach to use them. But it's going to be fun because we have a lot to talk about. And I think that's how you have to approach these markets. Now that this is out of the way, I think you take another look right now at the charts and you assume the Fed sits still, even though I would like them to go to the quarter point, and you trade according to that now for the next 30 days or so until we get through October into the November meeting, believe it or not. That's pretty much how I'm going to be viewing things. I'm Ira Epstein. Hope to see you at tomorrow's webinar. You have a good trading